Good afternoon, Jay and Terry. How are you guys doing? It's great to see you guys again.
Doing good, Sherry.
Always a pleasure, Sherry. Doing well. How about yourself?
Good. This week seems to be a busy one. There's a lot of things going on, like Jay Powell's speaking, earnings, and as well as the key economic data like CPI and PPI. So now let's get started. So as the stock market has reached the new all-time high, a lot of people have been like Morgan Stanley and Goldman Sachs. Yesterday, I saw their article said there will be a market pullback. According to the Goldman Sachs indicator, so when rate is higher than 70%, it means that market has been in for the bull trend for so long and is due for correction. So what do you guys think about the market right now?
I can take this first if you want.
Sure.
You can respond.
Yeah,
Cool.
Pile in. I'm sure you'll have comments on Mr. Wilson and everything.
Well, he's in a special group right now of two people, one of them named Marco, who has been really sticking to the narrative that the market can't sustain its advance. And they've been saying that for a long time. That doesn't mean this call is wrong, just because the same analyst has been prominently saying the same thing for a long time. At a certain point, even a broken clock is right twice a day. So I would say, though, let's look at the facts of the situation. The facts of the situation, there are a number of things that show an unsustainable trajectory in terms of positioning and sentiment data. One of the things that I look at, it's called index liquidity premia. Basically, if you look at the index ETFs like the SPY, how much trading volume goes into the SPY versus into individual stocks, it usually tells you something about complacency. If the stocks are getting the majority of the volume rather than the SPY ETF, then people are very complacent because there's less liquidity there. When people are worried, especially people who are trading with deep pockets and large amounts, usually they'll do more of their trading in the big ETFs because they know that they can exit in an instant if something goes wrong. So a timid market is full of people trading SPY, and a very complacent market is full of people trading the 500 stocks in the S&P. And right now we have near record levels of people just trading the individual stocks. So there's one point. Another one would be the equity hedging index. In terms of options data, in terms of futures, you kind of combine it all together into an index of different ways of hedging. You're very close to a multi-year low in terms of the amount of hedging that's right now in the market. That's another sign of complacency, which is basically amounts to vulnerability for the market. There are a few other signals in the same direction, but basically sentiment data and positioning data does not stand in the way of a pullback. A bull market is a trend. The trend can continue as long as it continues, but at certain points, the trend gets more and more vulnerable. If something goes wrong and people aren't prepared for it, that's when you get a correction. And we have a situation now where it's ripe for that possibility. Doesn't mean it's going to happen, but all the signs are in place that allow for that kind of situation. And one final point that I'll make, and I think that Jay's probably on the same page with me on this, which is if you start to see the market react poorly to dovish policy shifts in the Fed, then you're looking really at a sign that there's sort of a buyer's exhaustion point. So when you pair the vulnerability with buyer's exhaustion, you stack up these vulnerability elements. But we are coming into earnings season. We're going to talk about that more later. It's tough to short right in front of earnings season when you've got a lot of growth momentum. What do you think, Jay?
Yeah, no, I'm pretty much on board with what you had to say there. So just taking a look at what would a 10% correction entail, that gets us down to that 5,100 level around the April lows. So, I mean, you can look at that, and depending on, of course, how we get there, a 10% correction wouldn't necessarily be a major negative for the broader bull market theme that we're in. As it is, we're 300 points nearly above the 20-day moving average in the S&P futures. So we could shed some of the move that we've had in a healthy correction and not necessarily have that switch us into a bear market or anything along those lines. So corrections can be good for the broader market. You'd allow people that hadn't been able to participate, that didn't really feel like chasing, to get involved here. So looking at it from that context, and we are in a period where At the beginning of earnings season, you're still in the buyback block out. So that's going to last until July 19th. So it's not out of the ordinary for us to roll back and see a little bit of profit taken in the first part of earnings season. So that's just kind of mind. A correction isn't necessarily a negative, but to points, a lot of the things that you're looking at, certainly you can kind of hear data on the surveys for an overextended markets, but put off the AAII data, that actually declined last week. So there are people that are a little cautious out there, and the positioning, while certainly in the higher percentile, which might take off the potential for a blow off top here or something like that, it doesn't necessarily suggest that we're about to enter a period where a trap door is going to open up and you're just going to see a steep decline. Now, Q2 earnings season will certainly factor into that. A little bit about Fed policy, which is a key driver, the other one being earnings. And just to talk about Terry's policy, we had Jerome Powell today at first of the two-day testimony in front of the Senate. He's grilled by the senators on monetary policy. His prepared remarks, I was a little surprised. I was expecting something a little bit more dovish when you look at what he had to say in Sintra last week at the European Central Bank Conference. However, when he started getting deeper into it, he did make some dovish commentary, particularly about the jobs market. Remained upbeat about, but he did note that there was a considerable, and you could put that in quotes, pullback in the job market. So that's something that we're going to have to watch. They've been happy with the progress of inflation. And of course, we got a lot of key data points coming on that front towards the end of the week. So we see a kind of a listless sideways roll here, then I start seeing a bit of a correction taking place. But I think that the 20-day moving average would come into play. But again, some inflation data and a whole ton of earnings are going to factor into that.
Got it. Yes, speak of the economy, I have findings. So we are looking at 3 months data or 6 months data. And we saw that in the consumer spending sector, like Starbucks and Nike, the stock got crashed. I feel like that's also an indicator that the economy spending is going, and that also maybe one of the factors leads.
Just discussing that, Helena Troy this morning, of course, being the latest data point highlighting that. What's interesting is seeing the XLY rallying here, and of course, the primary reason, if you're scratching your head on that, is Amazon and Tesla make up about 40% of the XLY. But definitely been cracks in the consumer spending. And one of the key things that we'll be watching towards the end of the week is, of course, the bank earnings for, in particular, JP Morgan, Wells Fargo, and Citigroup, and watching the credit metrics in those plays just to see, how that situation is. Certainly, there's been plenty of signs. You talked about Nike, you talked about Starbucks, and these stocks have just been taken to the woodshed. Helena Troy being the latest one today. So, point out one issue that you could have with this current bull rally is the breadth has definitely left something to be desired. But you definitely seen a bit of a bifurcated market with consumer discretionary names getting hit hard. So if you see a rollover, there are names that you want to kind of radar for possible shorts. But at the same time, if they start holding up steady, then some of them could be seen as a little bit of value plays, especially if we see some improving economic data, particularly on the consumer spending side. But part of the market that we're in right now.
Got it.
Yeah, I would agree with that, Jay. And I think just to go back to some of what you're saying about Powell today, I would agree that the notes that were put out early seemed a little bit more hawkish than I expected. It sounds like a little bit more hawkish than you expected. And I think a little bit more hawkish than the market expected. But if you really kind of, what I would say, if you listen between the lines, he talked a lot about contrast between Q1 and Q2. So he said the things he had to say. If you're sitting in front of Congress in such a contentious election year, he said the things you have to say, but between the lines, he was painting a trend. And the trend is clearly that the Q2 data, when compared to the Q1 data, puts us on track for a September rate cut, in my opinion. And I think the markets, if we somehow end up closing red today or closing red for the week, it will effectively work as I think a reasonably good version of sell the news on a dovish shift in the Fed in the headlines. And I think that that is a good catalyst for some kind of corrective behavior. Said earnings is probably the more important catalyst, especially guidance. As Sherry pointed out, we can take away from that as far as the health of the economy in terms of stocks are getting hammered and which stocks are getting more worried. And the whole narrative, has the Fed waited too long to make this dovish shift? Have we already gotten past that point where the soft landing is possible? That's another major story that this market's going to have to deal with. And if we see the market sell off on a dovish shift in the Fed, I think you have to start to see there being a little bit of a narrative of the market starting to price in something like a Fed error.
Yeah, one thing that I would just add to that, and we are seeing markets rolling over here at the moment. Funds futures hasn't really budged at all, but they are priced in a September rate cut, as Terry mentioned. The other thing that we would just add in here, and this would be something that would come in more of the middle of August. There is seasonality at play where money market funds with their year-end date come in September 30th. So, that weakness around September and October that comes into play. Plus, you're going to have right in front of the election. And I think what the money market funds are doing is a lot of tax loss harvesting, right? And again, this kind of points to that bifurcated market. So you see some people that have been holding Nike, from that name. So it could add to a little bit of a further division markets moving forward. But, the next couple of weeks, certainly earnings are going to be factoring in largely here.
Got it. If the Fed is going to cut rate maybe September, is it time to buy TLT right now? So as Fed cuts rate, TLT will rally a little bit?
Potentially. Pull back a little bit, to Fed, but how the Treasury bond auctions do. There's a lot of supply still to come, be reactions around the elections. So I think the Fed, Terry, I don't know if you'd agree with this, is a little limited on what they could do in terms of interest rates and the TLT.
Yeah, but I personally, I've become kind of at this point. I like this. I feel like at the end of the day, and I kind of feel always right, and that there was a lot of impact from the pandemic and trying to reopen the global economy and having a lot of fiscal stimulus in the system at the same point. I can explain all of that. We haven't had enough of a demographic shift to correlate with what you see when you get a new normal in inflation and interest rates historically. And I think it's possible that, an abnormal period of higher interest rates is going to kind of what we saw before the pandemic.
Got it. So now let's move to earnings preview. So other than JPEG economic data release, on Thursday there's Pepsi and Delta earnings, and on Friday there's big bank earnings, including JP Morgan, Citi, and Wells Fargo. And Jay, I saw your article about the big bank earnings. So do you guys predict that the earnings will be a mild increase this time?
Well, so right now, the S&P as a whole, they're expecting EPS growth of approximately 9% year over year. And that would be the strongest quarterly growth rate since Q4 of 2021. And growth as a whole for the S&P 500 is expected to come in around 4%, which strong numbers on that front. Now, there is a concentration at the top of the names where EPS growth for the top 6 is expected to be 30% in Q2. The whole rest of the S&P is expected to grow about 3%, but still looking for some solid growth overall going into this quarter. So that should be supportive from a valuation standpoint, as long as companies are able to meet that. Now, in general, about 70% of companies do beat earnings on average. That's part of the whole earnings game with analysts. So right there, we're looking at for some positive reactions on a valuation front when arguing the earnings denominator there. As for the names this week, should be interesting. After the close, we're going to get Smart Global, SGH, Brazilian semiconductor play that does have ties to die chips in their IPS division. So that's going to be something that people are going to be watching just to kind of continue to get the boost if they put up big numbers in that section. Delta should be a good number, but it's not a great read for the rest of the airline industry just because there's such high-end flyers on Delta. So that'll be interesting. Pepsi, that's going to give us a great insight into the consumer. And then we move over onto the bank earnings on Friday. And I think we're going to be looking at closely there. Number one, loan growth, just for overall economic demand. And number two, the credit situation. We see the issues about jobs numbers starting to cool off, as Jay Powell said, considerably. So people want to see if this is translating into missed mortgage payments, missed credit card payments. And if that does, spur the Fed into action. Terry, your thoughts on this upcoming earnings?
Yeah, no, that we are probably going to be more important than the earnings right now. If we're seeing an inflection in terms of Q2 versus Q1 data and a lot of macro indicators, then, trying to get a read if that trend is going to continue for Q3 and Q4, and still see the same kind of soft landing expectations. But the other thing, because you mentioned Delta, you mentioned the airlines, I was just a little bit shocked to see yesterday that Sunday's travel day was the biggest airline travel day in history. Did you see that?
I did.
Yeah, I don't know how to account for that unless it's just always, bigger than ever.
Well, I mean, the thought process is number one, they're obviously not spending it on the consumer discretionary goods, right? So revenge travel is still in play. American Express is always a good name to watch on that front, where they'll break down travel and entertainment versus good purchases. So that can here, but much of the top 20% is doing all the spending, and that seems to be one of the concerns.
Right? I mean, the data point comes from the number of Homeland Security checkpoint passes.
Right, the TSA, right?
Yeah, like the people doing that. So it can't really be taken down to like one class versus another, because you're talking about just a total mass movement of humans on airplanes rather than prices paid or first or anything.
Right. Very, very true. My point would be careful to extrapolate a strong Delta report for the regionals doing well. Would kind of point on Delta there.
But what do we take away from that in terms of a lot of other data points that probably correlate with suddenly, airplane in the summertime? Sounds like a possibly strong indication.
Could be. Or it could be an anomaly, right?
It could be.
I see the travel trends throughout, and I'm just going off of the commentary that I've seen with regards to we had warnings from Southwest a couple of weeks ago. American Airlines warned a couple of weeks ago. So doesn't match up with that July 4th data. The other thing I guess you could kind of throw out Q3, right? That wouldn't be Q2 data for the earnings that are coming up.
Sure, absolutely. Point to make. Yeah, it just stood out to me as an interesting.
It'll be interesting. It didn't match up with the warnings that we got from some of the smaller regionals over the last couple of weeks.
Ready.
Yeah, I think probably wrap up our discussion this week. So there's still economic data and earnings we are gonna watch closely, and to see what will be the move next, whether there will be a market pullback or the rally.
I think that I'd be curious to hear Terry's thoughts on, in terms of, what if these earnings come in and you see a poor market reaction? Would you put that on par with a dovish Fed that you see poor market reaction?
Yes, especially if we're talking about the Magnificent Seven. If you see blowout earnings and you just don't get that rally reaction, and at the same time, there's more and more of a sense that the Fed is materially shifting to an easing cycle. If both of those end up spurring, red closes, then given our hedging in the market, I don't see how that's not more or less the perfect storm recipe for a market pullback.
Yeah.
Okay, thank you guys for chatting today, and we'll keep eye to the market and look forward to talk to you guys next week.
All right. Hey, thanks, Jay. Thanks, Sherry.
Thank you, Sherry. Have a good one.
You too.